In this week's Property Insider Chat, Dr. Andrew Wilson and I run through the latest property and economic news to give you some insights into the property market. Of interest is the government's proposed changes to immigration laws, decreasing the number of immigrants, especially temporary and student immigrants coming in, which will take a little bit of pressure off our housing markets. But we talk about the Reserve Bank's latest decisions, building approvals, loan approvals, housing costs, auction clearance rates, a whole lot of things. So if you want to keep up to date with what's happening in our housing markets, please subscribe to this YouTube channel and click the little bell icon so we can let you know each time a new show comes out. If 2023 taught property investors anything, it was to be careful who to listen to. The media was full of mixed messages about what's ahead for our economy, what's ahead for our property market, and most of the news was negative. Yet we ended up in the year where property values regained virtually all their losses of 2022. And as we finish this year, there's lots of clues in the financial news about what's ahead for next year. And that's what I want to discuss today with Australia's leading independent housing economist, Dr. Andrew Wilson, Chief Economist of My Housing Market. Hi, Andrew.
Yeah, good day, Michael. And we're getting very close to the end of the year now. And I'm looking forward to next week's podcast when we'll do the year in review. But we've certainly got lots of data to review today, and also some policy stories that are coming out, which are quite interesting in regard to the housing market.
Well, I guess the big news over the last week was that the Reserve Bank left interest rates on hold, Andrew.
Yes, I think it might have been a bit of a line ball. Perhaps I'm revealing my prejudices here, but yes, on hold, following that first rise since June that we had over November. And I think the data is supporting a bit more of a mixed outlook on inflation now. We had those 2 months in a row where inflation increased. I think that was the catalyst for the Reserve Bank to act on Melbourne Cup Day. But the data's been a little bit better. Inflation has eased over October. So I think if it was a line ball decision that they decided just to leave rates on hold over the final month of the year. Of course, they won't meet again until February. I think that's what the new rules are. And there won't be a lot of data to support them going forward. But I think, look, the data on balance has been a little bit more positive. And we've got some of that data today in terms of the direction of inflation going forward. So I think given the rise that they had, that they were feeling, okay, we can wait and see until perhaps next year when more data comes out. But no doubt the economy remains strong, Michael. Labour market still tracking at those record lows. Jobs are surging. Yes, migration's part of that. Even though unemployment numbers increased over the month, the number of unemployed has fallen over previous months. And we know the participation rate is at record high levels. Retail sales were down, but we expect that over October because of the Black Friday, November effect drags forward a lot of demand or pushes forward a lot of demand, as well as Christmas shopping now.
Well, let's make it clear. The retail sales were backward looking, as a lot of this data is. It was for October before the big sales.
Yeah, well, that's right. And that's why we saw, it fall. So there wasn't a big deal made of the fall because it is really reflecting new seasonal impacts, which November is now the big spending month of the year. Because of Black Friday, it's taken over from December, and people do their Christmas shopping in November, hunting out for those bargains. But even though inflation was a little lower over October, which is good, in fact, it was significantly lower, it's still way too high, Michael, and the Reserve Bank would acknowledge that. And we have a long, long way to go before we get back to the target.
Other news that came out was about home building approvals.
Yes.
We know there's a shortage of rental accommodation. We know there's a shortage of just houses to live in. So what were the latest home building figures?
Well, they've been bouncing around a bit, Michael. We're sort of used to that, particularly when we look at apartment development. But some better news there on the supply side. Home building approvals up 7.5%. Of course, that followed a sharp fall over September, down by 4.6%. Units, again, were the big influences on overall building approvals for homes, up 19.5%. But as I said, they tend to be volatile. You can get some big developments coming through from any given month, and that pushes up the numbers. Houses were up 2.2%. This is now the top, certainly was the top over October for building approvals. But there's no doubt when we look at the annual figures, they still remain chronically depressed, even though we had an improvement over the month. The year-to-date and the full-year comparisons are all very much below the line, and we continue to underbuild, and the trend shows that really total capital city dwelling approvals are now down 36.8% since the peak way back in 2016, and that's despite all that building that we had as a result of the home builder allowance. But the big fall has been in apartment development, Michael. Apartment developments on trend are down over 50% since 2016. That's, of course, one of the keys to why we're seeing this very tight rental market at the moment, is just that long-term decline in building approvals, particularly for units. And when we look at the state results over the month, Brisbane continues to be above the line. Its building approvals this year to October, so the year-to-date comparisons, are still 1.4% higher than last year, but all the other capitals are well below their performances of last year.
Well, just because buildings are approved doesn't mean they're going to come
That's
out
right.
of the ground. And I know my housing market's been keeping careful track of that. It's just not financially viable to build a lot of these big developments, is it?
No, that's right, Michael. And again, this has been a problem with Australia's inflation rate, has been the skyrocketing house building costs, which are a key component of housing costs. Housing costs in the CPI really are made up of rents and house building costs. That's what the major components are. And the sharp increase in house building costs since that home builder policy was introduced 2 years ago by the previous government have really contributed to our higher inflation rate, perhaps compared to other similar economies. Perhaps helping the Reserve Bank to some degree on their decision, we're finally seeing some better results in terms of the trend for house building costs, even though they remain at near record levels, high and well above where they were pre-COVID. We're now starting to see the annual growth trend falling, Michael, which I think is good. And it's now below 10% for the first time in well over a year. So we have annual house building costs on My Housing Market Index now rising at 8%, which of course is still too high. But we looked like we were going to be entrenched at around 10% there for a while. But the trend has resumed its downward journey since the peak, where we had house building costs rising a year ago by over 20%, but now 8%. So I think there's some confidence there that we might start to see more competitiveness in the house building industry with lower growth in house building costs. But we await that. So I think this latest data would have helped the Reserve Bank once again in its decision to put rates on hold. So as I said, on inflation and on some of the inflation components, we've seen some positive results over the past month, Michael.
Well, we've been saying how we're just not building enough dwellings, and the federal government's going to be releasing a new updated immigration strategy. They estimated that 510,000 people arrived in Australia in 22-23, and we know a lot of them were on temporary visas, on student visas. However, the mid-year economic and fiscal outlook, which is meant to be released on Wednesday this week, is going to forecast that net overseas migration is going to fall from 510 to 375,000 people in this current financial year, 23-24, and to 250,000 people the next financial year, 24-25. One of the new strategies proposed is a three-tiered temporary skilled migration program, but they're also going to see tightening of international student visas, Andrew.
Well, look, I'm surprised at the significance of these falls, Michael, particularly coming from a Labor government that we know is at the core committed to migration. These are very big declines, but let's face it, we cannot provide the infrastructure for the levels of migration, particularly housing, for the levels of migration that we've had this year, record levels. Of course, it's a bounce back from the lockdowns we had over COVID. But yeah, look, and good news for rebalancing, certainly supply with demand, but we're still going to see hundreds of thousands of new entrants into the market, Michael, which means in an undersupplied market, which we have, still upward pressure on rents, because I don't think we should be over-celebrating the decline. It's obviously positive because it would have been completely unsustainable to continue to have 500,000 new entrants into Australia every year. So this is a better outcome for sure, given we're really not seeing an increase in supply at all. But we've still got to try to find housing for those 200,000 plus in the next couple of years.
Definitely. Now, one of the leading indicators, the things that are going to give an indication of what's ahead that we watch carefully, are home loans.
Yes.
Because people in general get a home loan approval before they go ahead and think about buying a property. So what's the latest figures on home loan data, please, Andrew?
Well, correlating, as you said, Michael, with other market measures such as prices and auction clearance rates, we've seen a rise this year, a little bit up and down, but nonetheless, a trend rise in home lending, up by 4.9% over October, which is quite a steep increase. We know markets have been reverberating through spring spring, if I could say that, with certainly higher numbers of sales and activity levels quite robust. But yeah, 4.9% increase in home loans totally over October, seasonally adjusted. When we look at buyer types, investor activity has actually been strengthening, probably ahead of other buyer groups in that period this year so far, Michael. And it was certainly investors were the strongest performers over the month, up by 5%. Owner-occupiers generally up by 4.9%. But the trend for first home buyers declining continues. First home buyer numbers down just marginally by 0.1%. But first home buyer activity has certainly been the underperforming buyer type in the home lending series. And we shouldn't be surprised. Higher rents, high inflation generally, higher house prices, higher interest rates. It doesn't get much worse for first home buyers that are trying to save a deposit to get into the housing market, which is, as I said just then, broadly going to record around about a 10% increase this year in house prices. So no surprise, first home buyers have been the underperformers in the latest and the continuing home loan data for this year.
One other bit of data that came out was how our economy is going in the GDP. It dropped a little bit over the last while.
Yes, Michael, but still, I would suggest reasonably solid results there. We're really nowhere near a recession, which many of the scaremongers were trying to promote as a result of higher interest rates. A little bit lower, but still reasonably steady. And as I said, no real sign of a recession anywhere near here.
What the Reserve Bank wants, isn't it?
Well, they want, I'm not sure they want a recession. That wouldn't.
No, they want to slow us down.
They want to slow us down, you're right. But I'm not sure GDP is the element that reflects our spending levels. And spending that is all about inflation. We've got to spend less. And the way you spend less is if, unfortunately, you start to have some issues around your employment. And our unemployment rate is still way near record lows, very low. And that actually needs to be higher. I'm not cheering that on. It's just the fact of the matter is I think we're not going to really see victory over inflation until we have higher unemployment, regardless of what we see in terms of GDP numbers. But these GDP numbers are quite reasonable going forward. There's no sign of a recession here at all, even though they were a little bit lower over the month compared to previous months. And just a side note, government spending has been one of the key contributors to higher GDP, and lower GDP is still being affected by some of the positions on net trade, which is still sort of working its way through some of those COVID issues in terms of impacting the terms of trade for Australia, which works its way into GDP.
I just wanted to remind you that this is not specific investment advice because we don't know your personal circumstances, but we're more than happy to have a chat to help you take advantage of this new property cycle. If you think about it, the opportunity like this to get set at the beginning of a new property cycle doesn't happen very often. So why not have an obligation-free chat with my team at Metropole to discuss your goals and to discuss your options. We're much more than just another buyer's agent. We help you safely create intergenerational wealth through property. We're big enough to tip the scales in your favour, but still small enough to care. And as we don't sell any properties, our advice is independent and unbiased. Now remember, property investment's a process. It's not an event. So you can't just go out and buy any property and hope to be successful. In fact, now more than ever, getting the right advice is critical. So if you're looking to invest in property or buy a new home, go to metropole.com.au and have a chat with our multi-award winning team. It's a great feeling having the team at Metropole on your side, levelling the playing field. Well, it was the second last weekend for auctions too. There was lots more auctions on the market, and typically at this time, with more auctions, clearance rates fall a little bit. In general, while they did, they were still pretty solid, weren't they? There was quite a lot of depth to the market, which is a good sign that of moving forward into the beginning of the new year next year.
Yeah, absolutely, Michael. And I think, again, we had some positive results given the seasonal impacts we always see this time of the year, clearance rates falling because listings are rising. There's a little bit less incentive for buyers who are wanting to sell after they buy to be into the market until the new year. The same with sellers. Sellers would like to see those properties sold by the end of the year, but they start taking a longer term view of the market. And we were a little surprised last weekend, the previous weekend, because actually with higher auction numbers, clearance rates held up. In fact, they increased in Melbourne and Sydney, which I thought was a very good sign, offsetting those seasonal impacts. Down, which we would have expected. This is the second last weekend of the year for auctions. Clearance rates were generally down, but as you said, Michael, And we expect to see that. But generally, as you said, Michael, they were positive results. Big numbers of auctions, 844 auctions in Sydney, which was similar to the weekend before, well ahead of the year before. And Sydney was just really slightly down, 66.9% versus 69.6%. So still pushing towards that 70% result. Another very big weekend for auctions in Melbourne, Michael. 1,117 auctions, which was ahead of the previous weekend at 1071. And clearance rates were down, still above 60%, but these are big auction numbers and tracking higher than the auction numbers a year ago when markets were really starting to revive, if we remember. Brisbane ran about the same results from the previous weekend, 51.4%. We know Brisbane has a little bit of a different auction culture up there, so we need to take those results with it. They always tend to be lower than the market reflects, the underlying market dynamic reflects, but still 98 auctions in Brisbane. Plenty of confidence there from sellers in Brisbane. Adelaide's been the surprise performer, Michael. Over the last month, Adelaide has really fallen away. We've been used to seeing 80% every weekend, but it's actually fallen away over the last month or so, and a surprisingly below 70% result for Adelaide, but it is continuing the trend of the past month. But again, big numbers in Adelaide, and maybe Adelaide's just looking for a bit of a pause after what's been a very strong period in the market. And conversely, Canberra picked up a little bit. Big numbers in Canberra, 87, and Canberra certainly has been an underperformer this year generally, but just some signs there that the Canberra market is lifting off again. I think there's plenty of potential for Canberra next year, and maybe these are early signs for the prospects for Canberra for next year. And the trends, as I said, when we look at all the capital city markets, they have eased, particularly from that boom time period in May and into June, where we had nearly 80% clearance rates. But of course, with these high volumes and clearance rates still tracking around about 70% in most markets, the actual numbers of sales, Michael, are well ahead of where they were back in autumn, where we did have those 80% clearance rates. So when we just look at sales volumes, they're very high at the moment because we know we have high listing numbers. We're still getting 60 to 70% clearance rate. So that means more sales coming through. And as I said, that general trend is there. The only offsets that we can say in terms of an overall trend is Adelaide's certainly fallen away from those 80% clearance rates, tracking just under 70 now. And Canberra's moved in the opposite direction. Its trend is now pushing upwards, Michael, so far this month. So some good positive signs there. And of course, you can get those clearance rates on my LinkedIn channel, Doc Andrew Wilson at LinkedIn, every Saturday night. The snapshot comes through of the capital city results around about 6:30. And Michael, of course, you publish the regional national results with the regional breakdowns for Sydney and Melbourne on a Sunday.
Thank you. So one more Property Insider chat this week. I'm looking forward to our chat next week because we're going to look back at the year that was, and I'm going to push you for some forecasts for 2024. Thank you.
Thank you very much.